this. So, an introductory part to smart money concept. Smart money refers to the collective force of big money that can move the market. The first point, let me just make it known to you. When they mean it refers to the collective force of big money, they are not meaning a $10,000. It is too small. They are not meaning a $20,000 or $100,000. It is too small because it takes how much? $100,000 to move the market by 1 pip. Meaning, if the market has moved 10 pips, these big guys, they have used $1 million to move the market by 10 pips. 1 pip is equals one. For the market to move 1 full pip on the move, they have to use $100,000. So it means that no matter how much money you and I can put together in order for us to move the market, it is impossible for us to move the market because we do not have the edge to move the market using the collective force of huge amounts of money. The central bank, the other point, all right? So these are the big guys that we are supposed to follow. And this is how I want to show you how to trade the Forex market and think like banks do, because banks do trade Forex. So the central bank, these are the people who move the market. We have the hedge funds and other big institutions are the force behind smart money. So what happens is that for these big guys to make money, there are supposed to be other people who are losing money on the market. This is where now those people who only know about support and resistance will always lose money. If they make money, it is by luck. But if they consistently continue analyzing the market from the point of a retail trader, it is impossible for you to be consistent in making profit on the Forex market. So, for instance, when it comes to retail traders, let me show you an example. If this is a place where I'm drawing with a red annotation, let's say this is a resistance, all right? And this is support with an S. So the market will go up like that, reaches at the resistance. Retail traders will be here to sell, all right? And then they are going to leave their stop losses at the top there. So which means that retail traders believe that since there is a support, and a support, these are levels where the price of the market tries to go and break and then fails, it bounces back. So, and then support is the same, where retail traders will expect to buy from there, the market goes up, bounces from there, the market drops. As a result, the market keeps creating what we call a ranging market. But as a market maker who is trading and analyzing the market from the point of a market maker, will understand that up there is liquidity. Because a lot of people are going to use and put their stop loss orders up there, which means if the market makers uses a move up, which we call a stop and high, to go and hit the stop losses, because in between, if the market crosses your entry point here, you start to be in negative. So from your entry point to where your stop losses here, in between is the money, your money, which you're going to lose until the market hits your stop loss. Now imagine, it is not just you who is thinking in those terms. There are a lot of people, and altogether, if you put the money that is in form of stop losses here, it is millions of dollars, because it is not just us trading in Zambia, it is not just others trading in South Africa, it is around the globe, transactions are going on. So that is where now we take the term that for other people to make money, there must be other people who are losing money. That is the way of Forex. All right. So support and resistance traders, they tend to lose money. Same applies if the market comes at this level where there is support. A retail traders will say, okay, I'm going to buy from there. So when they buy, they'll leave their stop losses there. So as a smart money trader, you will wait because you know that there is liquidity here. Before the market goes up, it will drop down to come and grab liquidity. So the other name for liquidity is known as stop losses. The market will come, grab liquidity, then reject, and then start pushing. That is how people lose money. So this type of trading is for central banks, hedge fund managers, and other big institutions which are behind the force of the Forex market. Some may not understand. I know we have Mr. Bernard, you understand, but there are other people who are still, you understand, all right? So smart money, the third point, smart money negotiates large volume in the market compared to retail trader. So a retail trader, the other thing where you and I are disadvantaged is because we have small amount of capital to trade. Big banks, they can trade up to 1 million or up to, that is a smallest amount, 1 million, up to 1 billion a day. Just one bank, one central bank, all right, one federal, up to hundreds of $billions. This is the reason why they have influence, or they have huge force on the market, and they can do whatever they want. All right. So smart money negotiate large volume in the market compared to a retail trader. That's what it means. So the goal in this course is to guide you through smart money trading and help you identify specific market behavior that will allow you to trade and invest in harmony with market manipulation caused by smart money. Very, very, very much important. Okay, let's proceed. So what are some of the keywords to familiarize yourself with? All right, this is what now you should familiarize yourself as we are about to begin. Smart money. So smart money means big banks and financial institutions such as central banks, hedge funds, or etc. So smart money involves these big guys, all right? Big banks, not like Zanaco. Zanaco is a baby. Those can also be considered something like microfinance, all right? Those are small. They may be a little bit bigger in Zambia, but when we bring them on Forex, these are small baby institutions because they too borrow money from Bank of Zambia. Just like other small banks in America borrow money from the Federal Reserve banks, all right? So smart money means big banks or financial institutions such as central banks and hedge fund managers. Hedge funds are also institutions where those people or retirees take their money for investments, hoping to have profit or interest by the time they are retiring. So hedge funds, it has more functions. All right. So another term, the first keyword is smart money. It means big banks or other big financial institutions. The second one is mitigation. All right. This relates to orders. So what is mitigation? The keyword for mitigation also means this is where smart money or break even on their losses position. All right. Mitigation of orders. And other terms, it is a term or a move which big banks use to go and mitigate orders before they go to the right direction. All right. What another term is liquidity. What is liquidity? Liquidity refers to areas where retail traders put their stop losses and pending orders such as buy limit or sell limit. So in short, where stop losses of the majority are, that is where liquidity is. So for example, if every one of us here who are watching this, we sell here and our stop loss is there, that is why liquidity is. It means before the market drops down, we are going to expect a sharp move, which is going to look like genuine move, and it will go directly to try and hit the move up there, and then later reject and then go to the right direction. So what has just happened was that the market went up there to grab liquidity before it can proceed to the downside. That's what it means. We also have these terms, EQLS, small s. So EQLS also means equal lows. EQLS, these are just abbreviations. Okay, equal lows. EQHS, it means equal highs. So refers to equal lows and equal highs. EQL means equal lows. EQH means equal highs. And these are places where price visits more than once and reverses from those places. I hope you are getting the point, because we are just getting started. So let's now begin to section 1. Okay, let's now begin to section 1. Those of you who are joining us, I'm just laying an introductory part to smart money concept. Section 1, what do we have here? So let's talk about market structure, the introductory of market structure, all right, to advanced market structure, all right? What is the structure of market or market structure? What is it? Market structure is perhaps the most important aspect of analyzing the market and reading the charts. Because if you do not understand the structure of the market, it is the same applies as you cannot trade, because market structure helps us to communicate with the past, the present, and the future. So the structure of the market also helps us to determine the future movement of the market using the past. All right. So structure of the market plays an important role, as it gives us a visible representation of what is happening on the market or the financial market. Second point, market structure is the framework and backbone of the market. So it is the framework and the backbone of the market. I know a lot of people, many people, they just love using time frames, 4-hour chart. They just love using 1-hour chart, 15-minute chart. But without us understanding the market structure, it is impossible for us to make profit. I remember way back in 2019, my mother could give me money at month end. I invest in Forex, and then I used to blow. Again, because I never understood the structure of the market. But from the time after getting the points, I have never gone back to her to ask for money ever again. Why? Because during that period of time, 2018, all right, all I wanted was money minus having the right knowledge. All right. So a good understanding of the structure will elevate your trading beyond your belief. All right. In this lesson, we will go over different conditions of the market. So let's talk about the structure of the market. There are 3 types of market conditions or market structure. Okay. There are three types, there are three types of market conditions, all right? We have three types of structure. Number one, we have the trending structure. We have the ranging market structure, okay? Three types of structure. And we also have what we call a choppy market structure. And at the same time, we have three market conditions or structural type. We have we have uptrend or uptrending market. All right. So the market creating a series of higher highs and higher lows. Okay, thank you, Pastor Alan Mumba. Okay, so the first one is this one. This type, I'm sure you're able to see the chart right in front of you. This one is a trending. It is an uptrend, all right? And it keeps creating a series of higher highs, higher highs, higher highs, higher highs. In simple terms, if this was, for example, was Euro USD, like this, it means Euro being the best currency was appreciating in value against, all right, was appreciating in value against USD. So which means it kept creating the series of higher highs, higher low, higher highs, higher low, higher highs, higher low, higher highs. So HH means higher highs and HL means higher low. Okay, that's what it means. So this is the first condition of the market, the series of higher highs and higher lows. The second one is a downtrend, all right? A downtrend, which means if, for example, this was Euro, all right? Euro USD. It means USD being the court currency was appreciating in value against Euro. And Euro was depreciating at this moment, all right? Because if Euro USD, Euro being the best currency and USD being the court currency, and if the market was going up, it was in favor of Euro. Now, since the market keeps dropping like this, it is in favor of USD. I'll explain that later on another day when we have the session, when we have another session. So this means the market is in a downtrend, all right? We have two ways which we use, the jargon language, which we must all be used to. We have bullish market and we have a bearish market. Bearish market, these two names were derived from two animals. A bull means a cow or a bull, all right? Because a bull is representing the market that is moving up in an upward movement or appreciating or rising up, because a bull has its horns pointed up. And then bearish market, it was taken from an animal or a bear because it moves with its nose pointed down. So that is where the name bearish market came from. So if we say the market is bearish, it means it is dropping to the downside. If we say the market is bullish, it means it is in an uptrend. If the market is dropping, it means it is bearish in a downtrend. So if the market downtrend or downtrending market creating lower lows or LL. In the first one, it was HH, higher highs. Now this one, it is LL. So the market keeps creating lower lows, lower lows, lower lows, lower lows, lower lows, lower lows. This simply means that the first low here looked to be the lowest point until it was broken right there, and then the market dropped even more, created a more lower point compared to the first one. And this one looked as though it is the lowest point until the market broke down below by creating a more lower point than this one. Just like this, it is a sign that the market is in a downtrend. Thank you so much, sir. Thank you so much. So when you see something like this, for now, I am just trying to explain the basics so that when we start going in details, you'll be able to understand. Because the moment I come on the market and I look at this point like this, all right, I'll use the real chart to explain that. For now, let's just proceed. Okay? Because after I explain another one, the third market condition, I'll take you on the chart so that I can show you by actually practicing what I'm explaining here. So this one is a downtrend market. The first one, this one was an uptrend market with higher highs. The second one, a downtrend market, all right? So this one is a bear market. The first one was a bull market or bullish. What about the third one? It is a ranging market. This one is the one of the easiest market to read. One of the easiest market to read. So the ranging market, the ranging market is considered to be a ranging market when it is creating equal highs and lows. A ranging market is also called a consolidating market. So what does it mean, equal highs and lows? You see these points here where the market came, ended, dropped. That is a high. It came and created a low here, went up, created another equal high, equal with that one, came and created an equal low with this one. It keeps doing the same. So this one is called a ranging market, okay? It is a ranging market because as you can see, the market was coming from here, going well, behaving well, came, created a higher high, and then came and created a higher low here. With the expectation, the market went, broke that higher high by creating a new high there. But instead, it could not go anywhere. It started making a ranging move, up, down, up, down, up, down, up, down, just like that. So this is another third market condition. Now, what I'm recording this, what we are going to do, we will now in section 2, I will take you now on the market where I will start explaining the exact things that you are seeing here, where we'll give some of the examples of the markets. Now, before we proceed, let me take you now on the chart, on my investing.com chart. So that we can go through some of these powerful moves. All right. Can you all see my chart? Is my chart clear, please?
Yes, sir. It's very clear.
Oh, okay, fantastic. So now, when you look at this, let me ask you people, when you look at my chart, what type of the structure or what is the condition that the market was in? This one. Okay. So this one was an uptrend. Yes, sir, exactly. Yes, sir. It was an uptrend because the market kept creating a series of higher highs, all right, higher lows, higher highs, higher lows, and then it pushed higher highs, higher lows, just like this. So when you look at this, if I just let me use a 4-hour time frame. So on a 4-hour time frame, we are going to have a proper visual on this chart. So the market kept creating the series of higher highs, higher lows, higher lows, higher highs, higher highs, higher lows. It went higher highs, higher lows, just like that. Okay, so now this is where we would say the market was bullish. Why? Because if I start boxing using my analytical tools, I do like this, you discover that the market where I have just boxed with this white box, this thing here, you'll see that the market broke above these equal highs. Remember? So this was a third type of market condition where we would say a consolidation or ranging market. So the market here made a range until finally it broke out and then went up there. Let me use a white, went up there. All right. So here it created equal highs and equal lows. This one below, equal lows, equal low, and then equal high, until it broke up above and then went. Then after the market broke above, it went, it started creating the series of higher highs, higher highs, higher highs, higher highs. It was an uptrend, all right? From what was the date, all right? It was from somewhere from the move uptrend started from Thursday, 10 of November, all right? 12 hours on this candle. That's when the market went up there. Now, what about the other one? Because here I have talked about the ranging market. Hope it is making sense with what I was showing you there. Lower lows or equal lows, equal highs. It is a ranging market, okay? Also here, it tried to create equal lows, equal lows, equal lows. Mostly the market spent more time consolidating than it spent when rising uptrend or dropping downtrend. So when we come here again, you discover that the market was in a downtrend. Another last type of market condition, this one. The market kept dropping. Why? It kept creating. Now, before the market dropped, you would see that it was in a consolidation here, where I have put this, also known as ranging market structure. Here, ranging market. So the moment the market broke out of this ranging structure, which also had equal highs, equal highs, equal highs, equal lows, until it was broken down, it started creating the series of lower lows, lower lows. Remember, the other type downtrend is what the market creates lower lows, lower lows, lower lows, lower lows, lower lows, lower lows. It went back, made this range higher, equal highs and equal lows. Again, it touched there, it started dropping. So the market was in a downtrend. And actually, the market have been in a downtrend since way back from somewhere from last year. Yeah, last year on a Thursday, 10th of June 2021, 19 hours. The move started from this place here. last year. So the market has been dropping. Now, imagine if you had some maybe $100 investment, you sell from there, and then you hold. The market was just dropping. The market was just dropping. Do we have any other question before we proceed to the basic structure of the market? Anyone with a question? Anyone with a question? Okay. Okay, so what will happen? I always set the session. I do 40 minutes. So we are going to rejoin back again because the 40 minutes is about to end, so that now I can start the basic structure of the market. And I always use as simple language as I can so that every one of us can understand. So let's rejoin back again using the same link.